Hello and welcome back to our discussion on bonds. This is part 4. We said this time we were going to discuss a little bit more about the bond valuation analytics on a more quantitative level. We already introduced the idea of the inverse relationship between interest rates and bond prices. Bond prices obviously are the present values of the bonds. The price of anything is always the present value of its future expected discounted cash flows. So when we speak about the price of the bond, we're really speaking about the present value of the bond. Now, something I'd like to introduce before we move ahead, and we already touched on it a little bit, is the yield to maturity. And we also mentioned callable features, so there's also another type of yield called the yield to call. So I think what we should really do is focus on these two concepts for now, and then later on we'll expand. So YTM is the yield to maturity, and that should really be thought about as the rate of return that's earned on a bond if it's held to maturity. So this is really the rate of return. The yield to maturity is probably the most important metric in bond valuation, and it's really what investors quote to each other when they're thinking about purchasing a bond, when they're thinking about investing in a bond. So to find the yield to maturity on any bond, all you have to do is kind of plug in the values into the financial calculator. So PV, FV, PMT, I, and N. And this I over here is the yield to maturity. Don't get mixed up between the coupon interest rate, because the coupon interest rate is going into here. That's the coupon interest rate. The yield to maturity is actually the I over here, the function I that will be, the variable that will be put into the financial calculator. Now, something that's also important is to try and think, when you're doing these problems, when early on when trying to understand the yield to maturity, try and think about the yield to maturity as not just your individual rate of return, but it's also the market interest rate. And this is going to be very important when kind of doing checking on answers, or doing back of the handkerchief, if you will, calculations on how bond prices and interest rates are going to be affected by each other. So let's come back to yield. Let's come back to yield to call. Let's get rid of that, and let's do a yield to maturity problem. So let's scroll down here a little bit. Let's say that I have a 6-year bond. It is currently trading at, or let's say currently trading, and that is the same as the present value and the price and the quote, and all of these are just synonymous, at, let's say, minus, or well, the minus is going to be necessary, but let's just say it's $1,400. Its coupon is 7%. Its face value, face or par value, is 1,000. And we are looking for the yield to maturity. What is the yield to maturity? What is the rate of return earned on this bond if you buy it now at $1,400 and hold it for 6 years until the end of its term, until maturity, and you receive 7% coupons in the middle? What is the yield to maturity? What is the rate of return on this bond? So let's scroll. Now let's just jot the variables out over here. We have PV FV, PMT, I, and N. Now we know I is the yield to maturity, and that's what we're solving for, so we're just going to leave it at that. Now, what's the present value of the bond? Well, we see over here it's currently trading at $1,400, and we know that when we're on the investor side, it's going to be a negative cash outflow of $1,400 because we're expecting a positive inflow in the future of 1,000 because the par value is 1,000. That is our principal coming back. Now payments, are they negative or positive? Well, they're positive because we snip off those coupons and we send them in, and then we get back our cash, you know, from the disbursement agency. They disperse, you know, a check back to you when they receive your coupons. So this payment is going to be a positive cash flow to us. Sorry about that. Things are popping up. Okay, so our payment over here, we want to write this down and always follow this method. This is the way to do it. Don't just assume that it's, you know, 7% of 1,000, and therefore that's going to be 70. That is true, but always do it like this. Write down the payment is 7% of. So what we're going to do is we're going to write that the coupon payment is 7% of the future value, and the future value is 1,000. So 7% of 1,000, and that equals 70. Okay. Now N, well, we know it's a 6-year bond, so we'll just put in as 6. And what we're solving for is the yield to maturity. So we want to know what I is. Well, let's just have a look at this, because we can intuitively already know something about the nature of the answer. We know that the present value over here is 1,400, and the face value is 1,000. The future value is 1,000. So this bond is trading at a premium. It's trading at a premium. For some reason, the market is demanding an extra $400. There's a $400 premium on this bond. If you go out to the market with this bond and you sell it, you'll gain a $400 profit over face value, a $400 premium over face value. Now ask yourself, why? Why is this happening? So let's try and think back to when we introduced the inverse relationship between interest rates and bond prices, and we said that as present value increases, interest rates fall, and as present value falls, interest rates rise. Now over here, the present value is above the face value. As present value has gone up, the interest rates must have gone down. So this actually tells us that the yield to maturity, or, you know, as we said before, you can also think about it as the market interest rate. The market interest rate is going to be below the coupon rate, and let's think about why. This bond was locked in at 7%, meaning that it's paying $70. But if you're going out onto the market now, and you can charge a $400 premium, there must be something very special about this bond. What's special about this bond? Well, its coupon interest rate, i.e. it's $70 per year that it's paying you, must be higher than equivalent bonds that are being traded at the current market interest rate. So it must be that the current market interest rate is lower than 7%. This one is higher, and therefore that's why you can charge more money for it. Now, let's go to the financial calculator and see whether this is true. Now, if you've been to your calculator to calculate that, you should be coming out with 0.27, and that is far, far, far lower than the interest rate that was locked into this bond. So you can see this is far lower. So this is kind of an extreme example, but you can see that there is, you know, the inverse relationship between bond prices and interest rates kind of playing out right in front of us, right here. Now, let's move on to yield to call, which is a very similar concept, except it has to do with the call feature. Yield to call, or YTC for short, and this has to do with the call feature that we discussed in earlier videos, and even possibly earlier today. this feature is such that when corporations or governments, let's just stick with corporations for now, when they see that interest rates are dropping, what they will do in their finance departments is think, why are we still paying these very, very high coupon rates that were locked in years and years ago in those markets where interest rates were very, very, very high? Where if interest rate climate is currently gravitating towards a much lower, depressed interest rate climate, then what we should do is we should get those bonds back. Instead of paying $100 a year, we could get them back, and now the interest rates are at 5% of 1,000, we could be paying $50 a year. So this kind of call provision is something that is embedded into bonds, and it's obviously an advantage to the corporation because they can call their bonds back should they see that interest rates are going to fall. This is very similar, if you want to think about it in this way, to refinancing. So it's a very similar calculation in terms of the yield to call. The price of a callable bond, or the yield to call, is not going to be the yield all the way until maturity. And that's because if we draw out a timeline, for example, and we see that the bond is issued over here, and the bond actually matures over here, this is maturity, it could be that at some point during this timeline, let's just say over here, the interest rates start to drop, and meanwhile the bond that was issued over here by the corporation was locked in. So what they do is they say, well, listen, we'll give you a certain time period where we can't call the bond, and that is called a anti-call provision, which means that the investor can guarantee himself a certain time period where the bond can't be called. But let's say the interest rates drop over here, all of a sudden the corporation, they go and crunch the numbers, they do their financial analysis, and they understand that it would actually be cheaper for them in the long run to call those bonds back at a premium. What they will do is they will call over here, call, and once they call, the bond goes back to the corporation and the investor stops receiving coupon payments. So why would we want to know the return that's earned on the bond if it's held until maturity? What you really want to know is what's my return on the bond as long as I hold it. So essentially there is a big wall over here. When the call comes in, all you want to know is what is my yield to call. That is the rate of return on the bond if it's held until it's called and before its maturity date. Yield to maturity, obviously, is the rate of return that you would get if you held the bond all the way through until maturity. See? So that basically is the principle of yield to call. In the next video, we will do some mathematical example of yield to call, and you'll see that it's very, very similar to yield to maturity. It's not really that much more complicated. Alright, so I'll see you next time.